if we look at trends of the data, for instance, like employment data, it's clearly been weakening for months and months and months. Yes, it wasn't negative. Yes, it wasn't recessionary yet. But it's clearly weakening, and it's telling you that the economy is coming under a lot more trouble.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of the week for another weekly market recap featuring my very good friend, the Oric portfolio manager, Lance Roberts. Lance, how you doing?
I'm doing great, Adam. It's good to be here as always. And I don't know about Oric, but tired. That's a good one.
Well, I'm trying to stay on the positive side. Auric, A-U-R-I-C, right? Meaning of gold, like gold. It's been a just bananas fantastic week for the precious metals. Gold has broken out to new all-time highs, hitting them every day, hitting them again the day we're talking here, Lance. Silver, even stronger. I know you just put out a piece like an hour ago that said, "Hey, probably time to trim your gold, folks." So we'll talk about that in a little bit. But right now, yeah, Lance says Goldfinger.
Yeah. Well, no, like, you and I talked, I guess it was probably a month or so ago that I was talking about how gold had formed a really nice base. And if we could get a breakout here, that would be good. And you could definitely get a move higher. So that's occurred, right now. So the question be, of course, what happens next is always the case. But, as is always with investment management, when something like this happens, everybody gets all excited. So they start buying it now, instead of buying it when it was oversold and you had a good entry point. And so again, this is always the issue with, risk management in general, is trying to buy things that aren't necessarily working time. Gold just kind of went sideways for several months, wasn't really performing well. Stocks were doing a lot better. And so we talked about that kind of that flow of liquidity. So today is, stocks aren't performing well and gold is performing well. So, you're just getting this money rotation back and forth between, investment assets. And once the market kind of resets itself, then very likely we'll see money come out of gold again to go back into stocks. So it'll just depend on where the flows are going. So it's just important to always pay attention to those flows, and then don't forget to take profits, when you have good gains.
Yeah, okay. And again, we'll talk about
Sure.
this hopefully in a bit.
Yeah.
But I do want to, you've got a bit of a reputation here. Not completely unfairly deserved, but I think largely unfairly deserved that Lance hates gold.
I don't hate
No,
gold at
I,
all.
I I know you don't. I know you're impartial, and I know you have your all-weather portfolio that has gold in it all the time.
Yeah.
But I do want to call out the fact that you did say, as you said a month plus ago, saying, "Hey, for those who think I hate gold, gold's got a really attractive looking technical pattern going on right now." That's paid off. So anyways, kudos to you for that.
Thank you.
And your question about, what you want to do is you want to buy the things that are out of favor that have a lot of potential. One of the things I want to talk to you about, if we've got time today, is this the time to be buying into oil and the energy complex, given how much those stocks have underperformed and some of the real macro fundamentals that seem to be improving there. Yeah.
Yeah.
So we'll get to that, but a couple of things. First off, I just want to thank. I'll let you say whatever you want to on your behalf. I just want to thank the audience. We got a little personal in last week's market recap for very valid reasons. Reasons we're sad to have had to get into it, but this community really has a lot of support for you, Lance, a lot of love for you. I'm just going to tell you, I'm not going to ask you on air every week, Lance, how things are going. I know you got a lot on your shoulders and a lot you're dealing with. So we're not going to do a repeat of last week's unless you want to get in there, Lance. But I want to give you a chance to say anything else on this before we get back to our regular programming.
Yeah, no. It was absolutely amazing. I know there were a ton of comments. I know you got a ton of comments, but I just had a lot of people that emailed me directly, just wishing, well thoughts and prayers, and, for my wife. And next week we start chemo. So we had our doctor's visit yesterday, and so next week we start the first chemo treatment. But the prayers and the outreach mean more than probably, and they are very helpful, and we do appreciate them very much. I tried to answer every single one that came in. There were so many of them. If I happen to miss yours for any reason, I apologize. I tried to answer every single one that came in. So I hope you got a response. And again, if you email me, I try to answer every single email that comes in.
All right. All right. Well, again, thank you folks for all the
Yeah,
support you're showing here. And I'm just going to say, hey, look, my opinion, but I think one of the best things for Lance is just to keep him focused on, the stuff he needs to do. And part of that's his day job when he's not with his wife. So we're going to get back to the regular programming here, and we're probably going to get back to the regular, kind of ribbing each other. And don't think I'm trying to
sure,
kick a man while he's down. I think it's just trying to distract him and bring out help
sure.
him focus on the thing, the operate in the way he's used to operating. So don't
Exactly.
think I'm mean.
That would be appreciated. Yes.
Okay. All right. Well, look, I think the big news the day we're talking here, Lance, is um, the jobs market, right?
Mhm.
We talked about this last week, how that really did seem to be the thing that sort of forced Powell to change his tune at Jackson Hole.
Right.
And the data's only gotten worse since then. So we got the ADP numbers, which weren't great. We then got the JOLTS numbers recently and passed an important milestone, which was that there are now more job applicants than there are job openings. And that is a very different narrative than what we've been hearing for the past 3 years. You probably remember, Lance, when Powell
Yep.
started hiking, that was the thing he was really pointing to. Oh my gosh, look how many more job openings we have than applicants. This job market's way too hot. It's way too tight. We got to bring this thing down. We got to normalize it, right?
Mhm.
Now all of a sudden it's, oh, okay, wait a minute. Now we got more people who want to work than there are actually openings out there. Um, so then today we got the payrolls numbers, right? And this is, mind you, after the president publicly fired the head of BLS saying, "Hey, I think your numbers are too negative."
Right.
um, well, whoever's in the interim seat has got to be sweating bullets today because if you haven't seen it, folks, the jobs the payrolls came out at 22,000, only 22,000, a very low number, but it was quite low versus expectations, which were 75,000 jobs, which is not a great number to begin with anyways,
Right.
but 22,000, so a big disappointment. Then the June numbers were revised, the July numbers were revised up a smidge, but the June numbers, Lance, were revised down to a negative print for the month. And I think that's the first month since like May 2020, if I'm doing this from memory, where we actually had a contraction in the jobs numbers. So it's a big development here. Now, also the unemployment rate rose to 4.3%. That's expected, but all right, Lance, you and I have talked, many, many times about how if you look at the pattern of the unemployment rate, basically, once you're coming off a recession, that unemployment rate, comes down, 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 down. It then starts basing, and then once it's actually bottomed and it starts going back up, historically, it is then raced back up, and that's into the start of the next recession. So we are seeing the script seem to be playing out here now. Now it's still early, but it seems that more and more of this data is playing against the historical script. And so the question that I like to put out there is what for us not to be repeating that pattern, something's got to be materially different about this time. Is there something materially different about this time that argues against history repeating itself here?
No, I don't think so at all. I mean, it's funny because you were just talking about oil prices as well. And I just published an article last week talking about oil prices as an economic indicator. And there's a very, very high correlation between what's happening with oil prices and what happens with economic growth. And while I'm doing this, I'm actually running a couple of charts real quick because I was waiting for the unemployment data to update on Fred. Um, but when you take a look at what's happening with the employment numbers, and we've been talking about this for months now, is that
Yep.
hey, we said the Fed should have been cutting a lot earlier this year because the employment data was already slowing down. And what's important, and this is where most economists get things wrong, is they focus on a number. They go, oh well, employment's not negative. Okay, well, it being negative or positive is irrelevant. What's the trend of the data? Is the trend of the data improving? Is the economy getting stronger? Is employment getting stronger? Or is employment getting weaker? And if we look at trends of the data, for instance, like employment data, it's clearly been weakening for months and months and months. Yes, it wasn't negative. Yes, it wasn't recessionary yet. But it's clearly weakening, and it's telling you that the economy is coming under a lot more trouble. We're starting to see, college graduates having a tough time getting jobs. ConocoPhillips just announced that they're going to have a large reduction in workforce to become more productive and more efficient. And this is going to be, and AI is only going to exacerbate all of this, right? Because it's just, you're now able to replace more and more jobs with AI. It was funny yesterday, my wife and I were at the grocery store. We were buying some groceries for the trip this weekend, and we ran into our realtor that sold us our house that we're in right now. And even she's saying, she says AI is scaring the living daylights out of me because it's starting to come into real estate very, very quickly. And pretty soon, you're not going to need a real estate agent to buy a house because that's just filling out paperwork. And AI can do that very, very efficiently. So, there's a lot of jobs, there's a lot of businesses where, in the legal business or in the dental business or in, the real estate business, there's a lot of jobs in there. Now, you can't necessarily replace the dentist, right? You got to have the dentist has a job, but the receptionist, the people, filling out the paperwork, all the assistants and support staff, those jobs are all under threat. And so when you take a look at what's happening with this employment data, it's really a twofold story that's going on. First, it's telling you that the businesses are already shifting to become more productive by hiring less people, which is protecting profit margins in a slowing economy. So that's why companies are still producing good profit margins here, because they're cutting the bottom line cost. And that's showing up and being reflected in the employment data. But the other side of this is that the economy is simply slowing down. And we were running at 12 to 14% nominal GDP coming out of 2020 because of all that stimulus. And pig in the python has now come out the other end. The pig has now exited the python, and we're back to more normalized economic activity. And now you're seeing surges in delinquency rates on student loan debts and credit cards and mortgages, delinquencies picking up. So you're seeing that the consumer is becoming a lot more stressed. That's impacting the economy. As the economy slows down, the first defensive line for corporations is to hire fewer people and to find efficiencies. And that's what's going on here.
Yeah. So I'm just curious, how meaningful is today's news, just as a step along the trend that you're noticing here?
Well, it's real important. Here, let me try to share a chart with you real quick. I haven't had time to clean this up yet, so just forgive the dirtiness of the of the graphic. But so this is a chart of full-time employment relative to the working age population. So what you're looking at here is, how many people are of working age in the population and how many people are actually employed full-time. Now, why is that important? Full-time employment is what pays the bills, right? It provides insurance, provides health benefits. It's very hard to, raise a family on a part-time job. So full-time employment is very important to overall economic growth. And what you'll notice is that back in 1999, 2000, full-time employment relative to the population was approaching 54%. Very, very high level. We had, a very large percentage of the working age population was employed full time. Now, just because you're working age doesn't mean you work, right? It just means that you could be a housewife, you could be a student. There's a lot of other factors. But if you're in the working age between basically 16 and 54, you should be working in some shape, form, or fashion. We had more than half the population. We're now down to 49% of that. Now, what's important to note, though, is that when full-time employment as a percentage of the working age population, this is the only thing that really matters, is when that turns down, that usually precedes economic recessions. That makes sense, right? We start hiring, I'm going to start cutting back on my full-time employment. Maybe I'll hire a few more temps because I can just let them go really easy and they work cheaper. But you start seeing that reduction in full-time employment heading into recession. So 1999, recession in 2000, 2006, 2007, recession in 2008, 2019, 2020. Of course, we had the shutdown with the pandemic, and then we peaked out. And what was interesting is despite, this boomer economic growth that we had, we never actually even eclipsed the peak of what we had going in terms of full-time employment versus the population prior to the pandemic. We never got back to that previous peak, and we've now turned lower. And so it's important to watch this because again, that tells you again is that if I'm reducing the amount of full-time labor, that's fewer people that have the ability to really sustain a full, robust lifestyle within the economy that impedes
Yep.
demand. And that's why this normally correlates to recessions historically.
Yeah. So I know wait, actually throw that back up for a second.
Oh,
So
shoot.
you're showing us, the sausage as it's made here.
Yeah.
I know in that chart it looks like you're planning on shading in the recessions, which
Yeah,
I'm just guessing.
actually I have here's again, this is my work spreadsheet. This is what I build stuff off of. But here's a little different look. So this is kind of the same idea. This has recession shaded on it. This is the percentage of total employees working full time. So how many employees, how many people are employed? Okay. And what percentage of those employees, now this is full time and part time. So what's the percentage of those that are actually working full time? And you'll see the same. It's exactly the same analysis, just a little different look. But you'll notice that every time that turns down, that precedes recessions.
Yep. Yep, exactly. Okay, and that was sort of one of the points I was going to make. I'm curious, when you talked about us not getting back to the pre-COVID highs
Mhm.
in terms of the total workforce, um, a thought that immediately came to mind on that was probably a material factor of that was you had a lot of boomer employees whose stock portfolios, you know, zoomed higher with the trillions in stimulus that got shoved into the system, and they were able to retire early. And so we basically removed, kind of a lot of cream from the top of the workforce there.
Yeah. This is the same chart. I just wanted to show you this. This is the same chart overlaid against GDP. So you can see that whenever this turns lower, economic growth slows. And it makes sense, right? I mean, it's just those are kind of corollary in nature. But again, it's very important to pay attention to this because we're clearly seeing that impact back into the economy.
Economy. Yeah.
But your point's
So
right. But your point's right. There were a lot of people that were just became day traders and a whole lot of other stuff in markets and did real estate investing and never actually went back into the workforce.
right. So here's a risk here, right? No guarantee this is going to happen, but here's a risk, which is if we end up having a material market correction potentially coincident with a recession, right? Is you could have a lot of people who were 60, 65 years old. They still had potential years ahead of them to work. Let's say 55 and older, right? Who retired because their portfolios did much better than they thought. You could potentially all of a sudden have some material part of that cohort, if there's a big enough market correction, be like, oh, geez, I got to unretire here.
Yeah.
And I got to unretire right at the worst time, right? Which is when unemployment's zooming and, nobody's hiring, right?
Right. No, it's true. And look, this is why I've been, for years I've railed about people that wanted to retire early. This whole financial independence, retire early, and now there's a lot of articles out about how kind of Gen Z wants to retire by the time they're 35. It sounds great in nature, but the problem is at some point, and actually the guy that actually started the whole financial independence retire early movement, he retired early and he had to go back to work.
And he went back, yeah.
Yeah. So it's just, things happen economically. And, a lot of that stuff is based on these kind of false narratives that, oh, the market compounds at 8% a year. And you're going to if you make 8% a year on your money, you just live on 4% of that. And you have an extra 4% that grows and compounds over time. It's all fine and dandy until the market corrects 20%.
Right. And,
And
and you
kind of
have to
blows.
eat that year, yeah.
Yeah, and then all of a sudden you've got to go back to work, and then a multitude of things happen, which is you now and today more than ever, the risk of you taking and I was talking to my daughter. She called me the other day, and we were just talking on the phone. She says, "Yeah, my roommate's thinking about taking a year off and just go travel around Europe and then come back to school." And I go, if you even think about that, I will hang you by your ankles because that 1 year in this environment that we're in today, you take a year off, your skill gap is going to be so far behind your cohorts, you'll have a very, very tough time getting a job because technology is moving so fast with AI and everything that's happening right now. Take a year off, go have fun. Hey, I get it. We need a break, it's all fine and dandy, but that skill gap that you lose is going to be very, very hard to get back. And the longer you're out of the workforce, the bigger that skill gap gets.
Yeah. All right. Well, look, that might be a rant for an upcoming show here, Lance. I just want to show this chart,
Sure.
another way of looking at what we've been talking about. But this is what I was talking about earlier. Jobs added, payroll jobs added over the past, what's this, 2.5 years versus the unemployment rate. And just to your point about trends, Lance, right? Yeah, 4.3%. It's not a crisis rate by any stretch. But the trend here is concerning, right?
Right.
Which is that's continuing to go up right at the time where job growth is really just, petering out here.
Well, and again, and that's really kind of the important point. So I can't really see that chart. So that started in January
J
of
January of
23.
23.
Yeah.
Yeah.
So, and this is kind of my point. The federal, what Jerome Powell and all the markets and economists would focus on is like, okay, what was the jobs report? This number is like, oh, we had 300,000 jobs this month. Everything's fine. But again, you take a look at the trend of that data in either data set, right? The trend has clearly been weakening, not for months. It's been weakening for the last couple of years. And that's that pig that we talked about is exiting the python. And as that all that monetary stimulus comes out of the system, companies have begun to recalibrate. Well, people aren't spending as much. If you take a look at look at what just happened with Cava, Chipotle Mexican Grill. There was a salad, Sweet Greens. There was another one just reported all the other day. But
Lululemon just got clobbered.
yeah, Lululemon. Yeah, well, okay, Lululemon's got a whole other issue. So my partner, his wife is a news anchor for Fox 26 here in town. She's in a Lululemon store when a group of people break in and start just swiping everything out of the store and running out. And she's like interviewing the employees, going, are y'all going to call the cops? And they go, no, we can't because we'll get fired if we intervene or call the police. So yeah, not surprising Lululemon is down 20%. But
Okay.
it's funny because in Lululemon's report, they go, oh, well, it's the tariffs. No, your stuff is expensive as crap. And there's a lot of stuff that you can buy on the internet that's just as good as Lululemon for a whole lot less. And if you take a look at a chart of Lululemon, it is not a since tariff problem that Lululemon's been having. This is a 50% decline over the last year and a half in that stock because people are starting to cut back and they're finding better alternatives. But this goes back to what I was about to say about these restaurants. Every one of those restaurants that reported, they're all reporting that their primary cohort, like who eats at Chipotle, right? It's really not you and me. We're not
Yep.
primary consumers of Chipotle. It's kind of the younger generation that go there. It's kind of hip, it's cool. You get a burrito, way too expensive, but
Yeah.
that
It's
causes
not
them.
the Taco Bell crowd, but it is
Yeah,
younger,
yeah.
slightly healthier eaters. Yeah.
Exactly. But even so, but what they're doing now is they're seeing that group of people begin to cut back on their foot traffic into stores. So they're all having to make adjustments now, trying to figure out ways to attract that customer base back. And Sweet Green said they're going to add 25% more chicken and tofu to their salads that they produce to try to draw that crowd back in. But it's the cost. It's my wife's aunt and I had gone out to lunch yesterday with my wife before we went to go to her doctor's appointment. And she was talking about the cost of enchiladas. She took her daughter to Enchilada, which is another, if you're not familiar with it, it's like a salad bar restaurant, but
Yeah.
it's
I'm
it's
not, but I figured as
okay.
much with a name like enchilada. Yeah.
Yeah, yeah. You go into Enchilada and basically it's a bar and you go down the aisle and you say, I want this in my salad. And so at the end of the aisle, you have your salad made and
Yep.
it's in a bowl and they fill up the bowl with your salad. It's like $20 for a salad.
Yeah.
For a salad, it's $20.
Yeah.
you know, and it's just the cost of that has now reached the point to where consumers are going, you know what? I can either find places to eat cheaper or I'll just eat at
Mhm.
home, pack my lunch, whatever it is. And we're starting to see that shift in the economy now showing up in these restaurants as well.
Hey, let me ask you this. This is a bigger topic to explore, and I got some other points I want to make here, so I don't want to get too distracted
Yeah.
by this. But one of the uh, I think valid discussions that's going on around illegal immigration, right, is the whole like, well, who's going to pick your lettuce, and who's going to clean your hotel room and stuff like that, right? And the the pushback on that is, well, wait a minute, are you arguing for like a permanent underclass that kind of gets treated like, sort of slave labor, right? And
Right.
so let's say for a moment we keep the border shut to illegal aliens, and we say, look, we're going to fill those jobs domestically. And, to do so, yeah, we're probably going to have to pay a more living wage for folks to do this work. Folks are going to say, hey, this is easy for a guy wearing a sport coat and a button-down shirt to say. But, before COVID, I mean, I remember talking to people who would come to America from other countries, and, they would, in certain, depending where they came from, some of them would weep when they would walk into a US grocery store just to see the selection of food, but also the price. That, oh my God, this is so affordable, right? You people live like kings. And we may have just underpriced food in this country. And look, I get it. Like, the last thing the American household wants here is to see increased cost of living in their food. But I do wonder if we really focused on having like a more resilient, sustainable, um, uh, sustainable both workforce and sustainable, just pricing structure, if food should not be more expensive, because it is being grown and packaged by Americans, who,
Well,
want healthcare and stuff like that.
yeah, so the issues, right? Okay, so it's a noble thought,
I
right?
guess my point is like, is maybe is $20 a fair price for a salad in a store? And we've just been so used to, over the past 50 years,
Yeah,
of having cheap labor,
I hear what you're
or
saying,
too cheap food prices,
yeah,
labor
yeah,
for food.
I
Yeah.
hear what you're saying, and I'm not sure that there's actually a lot of truth to that. There may be some of that. Part of what's happening with the food price inflation is that when we started sending check, and again, this food price inflation really occurred over the last 5 years, more so than we've seen in quite a long time. And a lot of that was because we were sending checks to households, and companies were going, man, people are out just spending money, and there's a lot of demand. Everybody's eating out. Nobody wants to cook at home. They just want to get out of their house for whatever reason. Then we've got DoorDash. We've got all these other
Yeah.
things.
Yeah, so
And
just to say, another trend at the same time, though, was the rise in minimum wage. The forced rises and
Mhm.
big increases in minimum wage.
that too. And so you had that. And then you've also had all. So as we talked about a couple of weeks ago on the show, I was surprised to learn on the statistics that 75% of food sales from restaurants are delivery, right? I would have thought it was the opposite. I would have thought that at least 50-50, right?
Right,
Dine in versus delivery. But
right.
75% of their food is now delivery. And this is because we've made it so easy. People come home, they're like, I don't want to cook. There's nothing in the fridge.
Yeah,
I'll just DoorDash something.
yeah. We can. There's a lot of room for us to tighten our belts. I get it.
Yeah, yeah, yeah. But all that demand, right? All that easy access to demand allowed businesses to raise their prices, probably more so than they should have. Should have prices gone up? Sure, absolutely.
Yeah. But
But
I don't get
this
the sense
still
that restaurant margins have gone up a lot.
sorry.
I don't get the sense that restaurant margins have gone up a lot over that 5-year period.
Well,
We've had a
they're
ton of restaurants, at least out here in California, go out of business. That's been more the norm.
well, I don't know, but you take a look at a company like Chipotle that's growing their sales and growing their EPS, they're doing very, very well. And but a lot of this too, this pricing is also a function of Wall Street going, hey, you got, especially with chains, we want you to meet these margins and these demands. So they keep
Hmm.
raising the prices until there's a breaking point. And as long as you don't find that breaking point, consumers become accustomed to prices. If we keep charging $20 for a salad 5 years from now, people will go, it's cheap, right? It's been $20 forever, right? And we'll get used to that price. That's why prices never reverse. If we go to $4 a gallon in gas, it never goes back to $2 a gallon of gas. Maybe we go back to 3.50 or 3, but we never go back to where we were because we get used to higher prices. And when it goes from 4 to 3.50, you go, oh man, that's cheap again, right? So
Right,
we'll start
right.
buying, even though 3.50 was hugely expensive a year ago.
Yeah, yeah.
This
There's a lot to
this
that. Now, inflation's a big part of that too. But yeah, the airline
yeah,
never
but this
gives
is
you your
just
blankets back after it takes them away.
yeah, exactly. This is just consumer psychology, right? And so all this leads into these price increases. But again, consumers ultimately at some point there's a breaking point of that, and we're starting, and because now consumers are running out of money, now $20 for a salad is becoming a lot more of an issue than it was even just 6 months ago.
Look, and I totally agree. And
Yeah.
I want to stay on the point of the weakening consumer. So we can maybe revisit this later on. Just 2 points I want to make.
Yeah.
One is I think there is an interesting discussion to say, hey, has our food been artificially cheap for basically our whole lives because of the way and the labor that we use to grow and pick it?
Yeah, but AI is going to replace. But look, AI
That's
and
my point number
robotics.
two. That's my
Yeah,
next
AI
point,
and
which
robotics
is
is going to replace that.
it
So
will. So what's interesting is we may have who knows? We may have a period of inflation as we start replacing those workers with domestic ones, but then deflation in those prices as the robots then take over. Maybe it'll just be a wash. Who knows? But yeah, to a certain extent, the robots can't come along fast enough, especially if you're concerned about the cost of food going forward.
But yeah,
Um,
but just real quick, while we're talking about this, Chipotle Mexican Group runs a 22% a gross margin. So they're maintaining big margins on
okay.
operations. So
I'll be curious to hear what people who are work in the restaurant industry have to say in the comment section
yeah.
below. My understanding is that in general, margins have been getting real squeezed in that industry for the past 5+ years. But folks, if I'm wrong, correct me. So you mentioned, some of the old things that we talked about, like taking the Python and whatnot, right? And now that that's through, we're starting to see this real weakness creep in. One thing you didn't mention that I just want to also say is contributing here to the margin pressure on corporate America is the maturity wall that we've been warning about forever, right? We are starting to go through that in earnest, right? So every month here, more and more companies' debt is re-rating, which is just another pressure in the system here. And to a certain extent, same thing, with consumers as their debt has, we've seen APRs on credit cards and stuff like that go to record highs.
Mhm.
So this higher for longer effect, the lag effect, which folks, got real tired of me talking about for too long. I think we are starting to see the lag effect, the effects of the lag effect here in the material way that I thought was going to happen. I just, full disclosure, thought it was going to happen a lot sooner. All right. Well, look, so unemployment, the employment situation is not looking great. As the employment market goes, so goes the economy. Folks will continue watching this on a week by week basis here, obviously with Lance. I want to get to some of the pieces that you published recently, Lance. Before I do, though, let's just get to the TA if we can.
Sure.
Because, I mean, stocks haven't been performing great, but we're not that far from all-time highs. Is this a period where you're becoming a little bit more concerned about the direction of the market because of these macro issues, or do you think it's not time yet for the economy to drag markets down with it?
Well, I don't know why you say the market's not been doing great. It just hit all-time highs yesterday.
No,
So
but okay, but we've had a lot of chop, right? And
yeah,
then,
yeah,
but my point is, yeah, we're still near all-time highs, or we're at all-time
yeah.
highs. That red candle, what is that? Is that today?
That's today.
Okay.
We opened up this morning, set a new all-time high this morning, just after the jobs report. And it's funny because look, that jobs report sucked and tells you that the economy is slowing down. That's not good news, but the market opened up pretty positive this morning on the hope that's like, oh, great, this means the Fed's going to cut rates. And not only are they going to cut rates by 25, maybe we'll even get a 50 now, at the September meeting, but by October for sure, we're definitely going to have a rate cut, maybe a 50 basis point cut by October. So markets are now going, hey, wait a second, bad economic news may actually be bad data. So
So this would be a really big development, right? Because good economic news has been good for markets, and bad economic news has been good
yeah.
for markets for the reason you mentioned. Is the interpretation now shifting?
You can't tell from one day's action right now.
Yeah.
This market could close up positive by the end of the day. It's already starting to turn up from the low. So again, it opened up positive, it went negative, it's turned back up from the low on an inch. Here, I'll just show you real quick. I mean, this is what's going on right now. So I mean, you had your open, you sold off, and now you kind of rallied back up here a bit. So again, I mean,
Yep.
it's very possible. We and last 2 days in particular have been very important because we've seen institutional buying at the end of the day. A lot of it yesterday. We had a tremendous jump right at the close of the bell yesterday, and the day before also right at the close of the bell, a big jump in the price of the market because institutions stepped in and were buying the end of the day close. So again, it's been very bullish action on that front, and markets are continuing to do very well. There's absolutely nothing wrong with the markets right now. We're sitting right on the 20-day moving average. We actually broke that on Monday. We actually had a sell-off, broke through it on Monday, and then on Tuesday, right back above it again. So, again, these all the institutional buyers, these computerized trading algorithms, systematic programs, algorithms, etc. They're all sitting right along that 20-day moving average. So every time we hit that 20-day, they're stepping in and buying it. So that, that's this buy the dip mentality is there. And you can see this on the money flow as well. The market sold off. We had this real kind of negative divergence of money flows going into really kind of last week. But then starting this week, we had that dip back to the 20-day and they all stepped in and started buying. So we had this big surge in money flows over this last week. But what's important is and now from a bearish perspective, you do have a negative divergence in momentum and a negative divergence in relative strength. Those typically precede corrections in the markets when that
Hmm.
occurs. Last time we had that was back here and kind of really in December, February, and March, and then we had that turn down in April. So those negative divergences, don't not pay attention to them because they matter. But right now the market hasn't picked up on it yet. Very likely it will. So if we can get a break below the 20-day moving average, that kind of red line, which would also break that trend channel that we've been in now for the last few months,
Hmm.
um, you know, that's going to lead to an immediate test of the 50-day moving average, which is right below it. So there's not a lot of downside risk. It's maybe 2-3% from the peak. But if we crack out that 50-day, it's a pretty decent drop to the 200-day moving average. So there is risk of, a 5 to 7 to 8% correction sitting there in the market. What you need is some type of catalyst or event to actually structure that.
Okay. All right. So super interesting. Do me a favor, just just put your cursor over like February and March of this year.
Yeah, right here.
So you said we had negative divergences back there, and you can see we kind of had, we rose, but then we had chop going sideways, even though we went up to an all-time high,
Yeah.
and then it corrected really hard. Who knows? But I mean, starting in August now, the past, 40 days or so, we see a somewhat similar pattern where it rose up to that level, then it's kind of just been chopping around up there.
Mhm.
And we're in negative divergences. So to your point, I mean, would not be crazy for this to be the sign of a market that's kind of running out of propellant to go higher here.
Oh, and by the way, just while we're here, you and I talk about credit spreads a lot, and
Yep.
we've had a lot of requests. I was like, hey, is there some place I can go to find credit spreads? We've now posted all the credit spreads, so you can look at AAA, AA, single A, triple B. This is all the spreads related to U.S. Treasuries. So if I want to look at AA spreads to U.S. Treasury, you see where the spread is right now. Here's C. You can look at C-rated Treasuries. This is using the B of A data,
Yeah.
but you can see where the credit spreads are relative to treasuries. And we're sitting here at historic lows. So, you were talking
Yeah.
about that maturity wall a second ago. Credit
Yep.
spreads are not showing any risk in the markets right now.
Okay. I just interviewed David Hay, and he had a great analogy for credit spreads. He said they're about as tight as spandex on a sumo wrestler.
That would actually, that's a very good analogy. Yes, that's because that's where we are at the moment.
All right. And sorry, just go back to that chart again.
Which one?
The chart of the S&P.
Oh, yeah, yeah.
Yeah. So if we, and not saying this is going to happen, but if we went down to the 200-day moving average, I just can't see what that number would correspond to on the S&P.
About 6,000.
About six. Okay, which, it's not that nuclear.
No, no, it's
Yeah.
well, I can tell you what it would be.
It
If
would
we
be
go
what, about
from
8%? Maybe not
yesterday's
even.
high to the 200-day moving average, right? It would be 8.5%.
Yeah. Yeah.
So I
Okay.
mean, it's not the end of the world. That'd actually be a really healthy correction. It'd be a great entry point to buy stocks.
Yeah. All right. Well, look, you recently wrote a post. Anything else to say about the TA before we move on?
No, I mean, like, nothing's really, changed dramatically here. So
Okay.
yeah, it's kind of boring. And we said this we had our investment committee meeting yesterday with all our advisors, and we're like, another week, same story, really boring. It was a really short meeting. It was like 5 minutes. You know,
Yeah.
just nothing is happening right now, and it's so incredibly boring. You just, tech stocks work one day, they don't work one day, they work the next day, they don't work the next day. And it's just this rotation around the markets. So it's just been incredibly boring.
Let me just ask you this,
Mhm.
from pulling from those meetings, if you can. What
Sure.
would you say is, I'm going to say the most, and if you can't actually think of the most, just one of the big ones. What do you think is the most compelling reason for the markets to continue up, moving up from here, making new highs? And then on the flip side, what is the most compelling concern you have that could pull the market lower?
Well, the most compelling reason right now is that you just have a ton of sentiment, right? Investor sentiment is extremely high, and professional investors are very underweighted equities, and we're heading into the end of the quarter. So they're going to have to get allocated back to equities by the end of the quarter. And so if you look at hedge funds, you look at professional managers, et cetera, they're all very underweight equities. Retail isn't, but professionals are. So they're going to have to play catch up. If this market keeps running, they're going to get drugged back into this market, which is going to start pushing the markets higher. The more compelling reasons why you could have a correction is you're about to lose a major buyer on the 15th of the month, which is corporations. So you've been having about a $1.5 billion a day pull by corporations buying stocks since the buyback window opened up about a month ago. That's been helping lift the market, but that window closes on the 15th. So you're about to lose a buyer going into third quarter earnings, or sorry, second quarter earnings. No, sorry, third quarter earnings. I forget where I am. So
Yep.
third quarter earnings in October. So we'll lose that buyer. And then if this economic weakness picks up more and we start to see it reflect back in other data, if we begin to see earnings estimates come down because of that, that's going to impact markets as well. So look,
Okay.
this is all about earnings at the end of the day, right? So
Yep.
we've got to look at what potentially affects the forward outlook on earnings, and a slowing economic growth should start to eat into estimates.
Yep. Yep. So yeah, nothing impacts forward earnings estimates like guidance from
Yeah.
companies at their earnings call. All right, and I'm just curious. So you basically said it's a tale of two buyers in your mind. One is the institutions coming in to window dress. The other is the corporations ceasing their buybacks. In terms of just physical mass, if they were two fighters in the ring, are they equally sized, or is one notably bigger than the other?
Well, the professional managers are larger in size potentially. They've got more capital to move. It's just whether or not they will actually move the capital. Now, one thing we know for sure is that $1.5 billion a day that's getting bought into the market, that is going to go away.
Hmm.
That window will close and that buying will stop. So the question is whether or not if the professional managers sit on the sidelines and go, hey, we'll just be underweight equities into the end of the quarter, we're not going to worry about it because we just think the market's not in a good place to be, valid reason, and you lose that buyer, then potentially you have a lot more weakness going into the end of the month.
Got it. Okay. All right. So you recently wrote a piece about portfolio risk management, which is
Mhm.
one of our favorite topics here. You titled it "Accepting the Hard Truth."
Right.
So why don't you give us the skinny on the hard truth here?
Well, the hard truth is that portfolio risk management isn't easy, right? And it's the thing that we don't want to do. But really, the focus of the article is talking about portfolio position sizing, something that most people don't do. They buy it. Say, oh, I'm going to buy Broadcom today, right? So Broadcom's up like 13% after earnings. Great, you buy it today, and then you just buy some percentage in your account, but you really don't have any idea what you're buying. And then the other side of that is that what happens if you lose money? How does that impact your portfolio? So we actually go through an example using NVIDIA with a $100,000 portfolio about how to actually position size that into a portfolio based on what percentage of loss you're willing to take. And then that feeds into actually having stop losses in your portfolio, which is setting up either a percentage loss, which I don't like percentage losses because they're too arbitrary. And a stock like, say, Nvidia or Broadcom, they can move 10% in a day on a bad piece of news or some headline out in the world. And so you get tripped out of your stock. I like to use moving averages. So if the stock breaks out below a moving average, then that gives me a better stop point. And also that stop loss trails because it's a moving average. So I just adjust my stop loss for the moving average as the market's going up. But again, that's just the article's just going through just some of the basics of managing risk in a portfolio, because that's the one thing that investors don't do well is they're great. Investors are great at buying stuff. They're just really horrible at selling stuff. And it's just like, we were talking about gold earlier, right? You take a look at gold right now on a relative strength basis, it's massively overbought. Now, just from a purely logical perspective, you should take profits out of your gold position. Now, a lot of people's like, yeah, but it's going to keep going up. Yeah, maybe, but it's probably also going to correct here at some point, because every time historically that gold is this overbought on a relative strength basis, it goes down in price. Now, it doesn't mean it collapses, doesn't mean it goes down $1,000, but it's going to pull back to some level of support that was give a much better entry point to buy, to add back to your position. But if you don't take profits, you've got no capital to buy with. So, this is again, people are great at buying stuff. They just don't know when to sell it or how to manage the risk.
Hey, so there's a couple of things wrapped up in that. A lot of it just human nature. So
It's all human
behavioral
nature.
economics. Yeah. But human, I think the retail investor is way more guilty of this than the institutional investor. And as retail investors, we get excited about something. Oh, I heard Lance talk about, some stock that he thought was interesting, and that sounds cool to me. I'm going to buy that, right?
Right.
So it's really easy to come up with your trigger reason to buy into a stock. But if you don't come up with a sell plan when you come up with your buy plan, then that stock's just sitting there on your portfolio, and you have no real trigger to know when to sell it. And this is why so many people will ride a stock up and then ride it all the way down when it's performing poorly, right? So a big part of it is either, get real good about developing your sell rationale when you create your buy rationale. Or if you don't want to do that, the easy answer to everything we're talking about, Lance, is just outsource it, right? Which is to
Right.
hire a professional like you and your firm who can do this for you, right? But the other trap that I think folks fall into, and gold is a really great example of it, is, hey, I'm owning this for the long haul. So Lance, I don't care what gold does this year, any given month to month, because I'm going to hold this for the next 10 years, right? Just compare and contrast that strategy with somebody who says, yeah, I want to own gold for the next 10 years too, but I'm going to take advantage of, actively manage it when it gets overbought versus oversold. How
Yeah.
will their performance results differ?
It will perform vastly differently. Just take gold as a good example, and basically from 2020, the mid of 2024. Oh, sorry, I gotta let me get my dates right here. I'm just going to use GLD as an example. This is a weekly chart. Probably gonna do monthly better. Yeah, here's a monthly chart. This is better. So this is a monthly chart of gold, and this is what we talk about a good bit. Is that when, and let me kind of zoom in here. So from 2000, 6, 7, 8 through, it did great. And then you lost a very big chunk of your value in 2000, really kind of 8 going into 2009. And then, yes, if you just held it, it worked out fine. And you came back and then you kind of peaked around 2012. And then you went nowhere for basically 10 years, and gold just traded lower, a lot lower actually, and then it finally got back to where it was 10 years later. So from an investment standpoint, again, you take a look at this. It was three. No, this is a monthly chart, so this is a very long-term chart, but it was 3 standard deviations above its monthly moving average. So whenever it's you get to those levels, you're going to have a correction at some point back to those moving averages. It's a function of gravity. It happened back in 2007, 2008, happened here in 2012. Again, happened here. You got 3 standard deviations oversold in 2020, went nowhere until 2024. And now you're massively just this extension is beyond just about anything that we've seen previously. So this correction ultimately in gold at some point, when it retests this long-term moving average, and what causes that, who knows, right? But something will come along. It's a commodity. It's not an asset. It's a commodity. So when that commodity trades back to its long-term average, which it will, that's going to be a fairly substantial price decline. Now, that doesn't mean it's going to go straight down there. It could be very much like we saw from 2012 to 2020, where it's a very long grind lower and then finally rallies back higher. But again, these overbought conditions, and again, you take a look at relative strength at every time that gold has been this overbought on a relative strength basis. Again, this is a monthly chart, so very, very slow to move. But there was your peak. Here was your peak. Here was your peak. Here's your peak, right? Every time the gold is this overbought, it ultimately corrects because it's a commodity. It's not money. It's not a currency. It's a commodity, and commodities trade. And what trades commodity is what translates to the price of gold is how commodity futures are traded. Your long trades and your short trades. And if at some point there's ever an imbalance of that trading, that's how you get these very big corrections in the price. So again, whatever drives that correction, it's just like stocks. Everybody talks about, oh, stocks are so overvalued, they're going to have to correct. Absolutely correct. But what you need is a catalyst. And at some point, stocks will have a very large correction in the price of their, because of their valuations, have a very large correction in price, but you need a catalyst for that. So at some point, you get a catalyst that causes this correction and this deviation in price. And that's just a function of time till it occurs. So this is why if you can navigate this, and use opportunities. This is where you and I were talking a while back. We said, hey, gold's very overbought here. It's going to correct here. And then this round over here was where you and I started saying, hey, gold's worked off through this consolidations, worked off a lot of this overbought condition. Here was the relative strength overbought. And we said, this is where it's really overbought. Wait for a correction. This is where it got really oversold. This is where we said, hey, this is a pretty good setup to buy gold. You're now back to a relative strength overbought. And again, every time you get to these relative strength overbought conditions, here's your peak, here's your peak, here's your peak, here's your peak. Take some profits. Doesn't mean sell everything, right? We don't sell everything. We own gold in our portfolio. We don't sell it all, but we trim it back. So if we have a 5% position in gold, it's now 7, we trim it back to 5. Use that cash for some other investment, or we holding cash until we're ready to buy gold back. Because again, it will give you an opportunity to buy it back cheaper. And if you can do that over time and just manage that portfolio risk and not suffer those long periods of drawdowns where you're either flat or losing money for 5, 6, 7 years, which is a consistent norm with gold, then you'll come out much better in the long term in terms of your total return basis.
Okay.
But
Um,
this is also why find me one, just one portfolio manager in history that buys and holds.
right. I mean, you wouldn't need a portfolio manager if you were just buying and holding.
Exactly. And you wouldn't have a market either because the market would just trade flat. If everybody just bought and held, it would just be flat.
Yeah. Okay. So clearly the chart catches your attention with the breakout that gold has had of late. Very stretched in terms of valuations. And I want to be consistent here because we talk all the time when we think the regular equities have gotten stretched. And so I
Yeah.
want to say, hey, same thing can happen with any other asset class, including one like gold. Um,
Well, and that's an important point. I was just about to say that is that you could apply that same analysis to stock, to Bitcoin, to gold, to silver, to platinum, to uranium, to corn, cotton, wheat. The technicals apply across the board for every asset, and every asset performs exactly the same relative to their technicals.
yeah. So gold is a little different. You might disagree with people's reasons why they think it is so,
Uh-huh.
but there's people that are holding it as sort of like inflation insurance or maybe even Armageddon insurance. Like, I've got fears that, we're going to have a currency reset or whatever, right?
Mhm.
So, you don't have to agree with those assessments, Lance, but some people hold it, like I'm going to hold this for the next 10 years and they'll hold it in physical form, right?
Sure.
So it's easy. It's much easier to trim back your precious metals exposure if you're sitting in GLD or some
Sure.
paper traded thing. There are reasons for why somebody might say, you know what, I don't want to give up the ounces of gold that I have. What would your advice to them be? Would it be buying
Hedge
some
it.
put options or
Yeah.
whatever, but just something that
Or
gives a price offset?
yeah, yeah. Just hedge it with. So if you've got, let's say you've got $100,000 worth of physical gold sitting in a vault, right? Yeah, go buy some put options on gold, right? Go buy $100,000 worth. You don't have to, you wouldn't have to spend $100,000, but you can buy
Right.
$100,000 worth of put options
Of coverage. Yeah.
of coverage to hedge your position for, it wouldn't cost you much either. In a lot of cases, probably, 10, 20 grand. you can hedge your whole position. I don't know what the number would be. I haven't actually
Right,
looked at it.
right. And
But
you don't even have to hedge your whole position. You could say, well, I'll hedge half of it, right? I mean,
yeah, yeah,
it's
yeah. Pick a number. Or buy an asset that goes up when gold goes down in price. Just buy a non-corollary asset to hedge that. So,
right. And
you
they
know,
do have inverse gold funds too. I
and
mean,
there you go. You could buy,
that
yeah, you could
they,
actually
they
do
have
that.
issues over time, but yes.
Yeah. Yeah. So I mean, yeah, there's tons of ways to hedge your position so you can lock in that value. And again, but this applies to every asset. It's just, it's not just gold. It's, if you own Nvidia or if you own Broadcom or you own Procter Gamble, it's the same thing. If you have a very large concentrated position in something, then learn how to hedge and portfolio and manage that risk, because if you do that, you can survive the down. That's the whole trick to this is survive the downturns. That's
Mhm.
every asset goes up in price, every asset goes down in price. And it doesn't matter what your thesis is, right? Long term, doesn't matter what your thesis is. If we have economic Armageddon, it ain't going to matter, right? Because the only thing you better have is guns and lead, because you can have all gold you want, but you don't have guns to protect it. Somebody will come get it from you. So, um, you know, just keep in mind that everything goes up in price, everything goes down in price, and we just need to hedge that risk of those losses, because if we're spending a lot of time just getting back to even, whatever our thesis is. A good example is as we just showed you, right? Gold was flat for 10 years from peak to peak, right? So 2010 through 2020, it just was flat. So as an inflation hedge, it sucked, right? Stocks did a whole lot better in terms of that, in terms of protecting your inflation adjustment during that period. So, forget all those theses, right, that people put out. Most of those theses that put are out there are from people selling you gold. And then you just always ask the question is, well, if that's your thesis, then why are you selling me your gold? Why aren't you keeping
Mhm.
your gold
Mhm.
if you're selling it to me? But just think about how this is hard value money, and just think about what am I trying to achieve with my money. And it doesn't matter how I achieve. If I'm worried about the future purchasing power of my dollar, which is all you should be worrying about, I can achieve that through a variety of different ways. So just choose which one works. And if one's not working, find another one that is. And then you can always, and this is always the other thing that Adam that gets me. Let's just say that you said, I'm going to sell all my gold today. Gold's overbought. I'm selling all my gold today. For some reason, people think that if they sell all their gold today, they can never buy it back. It's like they're kicked out of the club of gold ownership, right? It's like, oh, no, no, you sold all your gold. You can never buy it back again. No, that's not the way it works. You can sell all your gold today if you want, and you can buy it back cheaper at some point in the future and capitalize on those gains all over again. There's no exclusive club to any asset.
That is a great reminder. And people, again, like I said, it's human psychology. We sort
Yeah.
of tell ourselves these things, right? Okay. Tell me since you have been in the business of working with clients for
Mhm.
decades and you've seen it all, what's worse? The guy that says, you know what? I looked at that and gold was 3 standard deviations up and I sold a whole bunch of it. And then it went up even higher and it
Yeah.
didn't correct, right? And I
Yeah.
missed out on those additional gains. And man, I would have done so great if I stayed in, right?
Mhm.
Versus the guy that stayed in, didn't hedge, and then it had a material correction, maybe years long.
Yeah. It's they
I don't
all
think they're
suffer.
equal.
They are
I
equal.
think we think they are, but I
No,
don't
they
think
they
they
really
are if you're going through it, right?
they are equal in this manner, right? The guy that gets out early, right, that took profits, and there's some great investors throughout history that their whole motto is I'm glad I sold early, right? They always
Mhm.
sell early, and they're just not greedy. It's like, hey, I made money and I put that away. And remember, any asset you have is only, when you look at your portfolio and you pull up your portfolio on your computer screen today, that's not real. That's not real money, right? It's not real money till you convert it into cash, right?
Right.
That's when it becomes real money. It's all ethereal play money. It's monopoly money until you convert it into something that's spendable, hard cash. So, the guy that sells early, he makes the same mistake as the guy that sells late, which is I sold it and it went up without me. And then when it does correct, because it always does correct at some point, prices always correct, he doesn't buy it back. Because again, he thinks he's in this club that he sold it. He's never allowed to play it again for some
All
reason.
right. All right.
And so he hurts himself by not just managing his sell, but also managing his buy. And look, that's part of portfolio risk management, is also managing the buy and the sell. And this is where people go wrong, is again, they're good at buying, they're terrible at selling. And if they do sell, they're terrible at buying again. And I've never figured out the psychology behind that, why that occurs. But I've bought and sold Eli Lilly. I can't tell you how many times over the past years, or AbbVie. We Nvidia. We bought and sold. I can't tell you how many times. We don't sell all of it, but we sell it, and then when it pulls down, we buy it back and build our position back up and make more money with it. So again, that's the thing. I think you've got to leave a lot of this emotional baggage at the door and just focus on what are you trying to achieve, and then focusing on the best way to do that.
All right. So I agree with all that. Your answer was different than what I was expecting, because uh, I was expecting you were going to say, hey, look, bird in the hand is better than two in the bush, right? In other words, like, look, if you've taken your gains and then the thing continues to run up, you got your gains. Congratulations.
Yeah.
Lock yourself in, right? It's sort of like, you know, um, somebody who can't afford a house finally has enough gains that they use to buy a house, and they locked in that house, right?
Yeah.
And then that investment that they sold went up even more, and they're like, oh geez, I could have bought a McMansion with that instead of a regular home, right?
Yeah.
Yeah, but you still have your own home and a roof
Yeah.
over your head, and you're in a good shape, right?
That's
Versus the
great.
guy that had enough to buy the house and then held on too long, and then now he's stuck renting forever, right? Like, you're better off
Yeah.
you're better off if you buy and miss out on some more gains, right? I mean,
No,
look,
that's
yeah.
and that's what I said. Like, there's great traders in history that they're like, hey, we always sell early, and they don't wait till that last minute. And that's the biggest mistake that investors make. They're always trying to get the last little clip out of some rise. It's like, oh, I'm going to get it right at the top, right? That's impossible to do. And now look, I can't tell you how many times throughout my investing career I have watched people turn very large chunks of wealth into zero.
Hmm.
And I'm not talking about a few. I'm talking about a lot. And some of them are obvious. I mean, I knew people that worked at Lehman, saw their entire 401k plan go to zero. Enron saw their entire 401k. Those are the one-offs. But during the financial crisis, I saw people with huge portfolios of Citigroup and Bank of America and other stocks that had been given to them, gifted to them through estates and those type of things. And they had, 3, 4, $5 million worth of the stock, hugely heavily concentrated position in their portfolio. And it's grandpa's stock, so I can't sell it because grandpa would have never wanted me to sell this stock. And they watched it go to basically zero. And the guy, I'm like, dude, grandpa didn't leave you the stock. He left you the wealth. He wanted you to do something with the wealth, not just watch it just get destroyed. But these are the mistakes that we make. And again, it goes to every asset class, is that, yeah, you're always better off selling early. And again, but the point is that you don't have to sell everything either. When something's going up, if you own $100,000 worth of gold where it is right now, I'd sell 20% of it and lock that gain in. And then when it corrects, take that 20% and buy back your position back to 100 grand. So, you can continue to accumulate over time. But if something goes wrong and that decline keeps going, well, at least you got some of your gains out of it. And then you can sell some more, rework your position, however you want to do it. But that's what I'm saying, is like, you just have to manage the exposure to your portfolio with some type of rules in place. And the biggest problem I think that most investors have is they have no real set of defined rules. They just start throwing money at the market, and it makes sense, right? I just throw money at the market; it just goes up every day. I buy gold. Why buy gold? Because it's going up, right? So I buy more gold. I buy more Nvidia. Why? Because it's going up. There's no real strategy or structure to the portfolio. There's no investment rules. There's no kind of guidelines to follow. So you get lost really easy, and we start getting trapped into these narratives that, we start looking on the internet, right? We start looking for people that support our views, like, oh yeah, gold's going to the moon. You better just buy and hold. Or, Bitcoin, remember the whole buy and hold thing is hodl Bitcoin.
Total.
And so it feeds our confirmation bias, which is fine, except eventually something's going to happen and Bitcoin loses 50% of its value, and those things happen.
Yeah, and what's interesting is, I've seen this a lot, and I know you've seen it a lot more than me across your career, Lance, is you talk to people about this and you kind of get the, yeah, I get it, I know, right? And then the correction happens, and then people are like, oh, why didn't I listen?
Yeah.
I mean, it's such a, like, you get it academically, but you don't really get it, truly understand it until it goes against you. And then, of course, it's too late. So anyways, good discussion. Probably two key things I want to just note for folks, which is 1,000% agree with Lance, is that you need to have a framework for why you're buying, why you're selling, and how to do this trimming that Lance is talking about. So either develop it if you don't have it, and to be honest, most people don't ever develop this. So if you don't, then outsource it. Leverage somebody's expertise who does this well for a living. Secondly, and this has been a really good, timely discussion for me because I've owned precious metals, and so it's been a great year
Mhm.
for the precious metals part of my portfolio. And I myself wrestle with these emotions, right?
Yeah.
So hard to consider selling this stuff because, oh my God, it's done so well. And it's finally done well. Like I've been holding on to this stuff for years, a decade, and it just hasn't gone anywhere. And man, now it's actually performing. Why am I, brain screaming, why are you selling this thing right when it's doing well? And everybody says, let your winners ride and all that stuff, right? And I think the only thing that I'll say about this is Lance's logic is very sound. And if you're having trouble just getting started here because it feels so unnatural to click the sell button, just sell literally $20, $50. Like
Do
just
something.
just do some, just prove to yourself I can actually sell a little bit of this. And you know what? The world didn't end,
Yeah.
right?
And nobody showed up your door to beat you with a club. So,
Right.
uh,
Exactly.
so real quick, I was just gonna we just published this about 2 weeks ago. If you go to our real investment advice website, under resources, we have a link called Financial Survival Guides. And the very first guide that we have on this is called Real Investment Advice. And what this guide is it's about 20 pages long. It's a very easy read. But what I've done is I've put together all of our investment rules. So we talk about rules that matter in investing, emotional investing traps, investor, speculator, buy and hold myth. A lot of the stuff that Adam and I talk about, we've put it all in writing in this guide.
Oh,
So
it's super
it's
useful.
free. It's free to download. Doesn't cost you anything, but we just go through all the emotional traps that we get ourselves into, all the rules to follow to help you just kind of navigate your portfolio a little bit better. But again, just go to realinvestmentadvice.com, click on the resources and financial guides, and it's the first guide on the list.
That is super cool. I love the fact that you guys have done that, and I'm sure you're going to keep adding guides to that
Yeah.
channel, right?
Well,
Yeah.
we've got a bunch on there already. We've got retirement income guide, financial guardrails, ultimate chart guide for an investment life. So there's an annuity survival guide on there as well, severance packages. So there's quite a few guides in there, but the latest one is called Real Investment Advice.
Okay. All right. So we were just talking about things that were really overbought, in some cases by several standard deviations. Talk for a moment about things when they're really underbought, which is also another hard time to buy them because you're like, everybody hates this. This thing's been performing miserably. Why should I
Yeah.
take my hard-earned cash and plow it into this thing? But we gave an example earlier that energy maybe really be kind of at a multi-year bargain right now.
Yeah, so a good example of this is just happened not too long ago. Actually, there's a company kind of, and I just picked one off the top of my head. Um, but this is Arista Networks. And back in, this stock has been performing exceptionally well. And then during kind of February, March, before you had the whole tariff blowout, right? This stock was just selling off. They announced earnings kind of missed the mark a smidge, and the stock was really getting hit very hard. So it was, again, you look at this chart and it looks a whole lot like everything else, right? So three standard deviations overbought, extremely extended, but people couldn't wait to buy the stock. Hey, this stock just goes up. You just buy this stock. You look at the chart, it just goes up and up and up. It's just incredible. So you buy the stock. Three standard deviations overbought. They come out, they make one announcement, and the stock loses a very big chunk of its value, lost about 50% of its value. got 3 standard deviations oversold. Now, the fundamentals of this company did not change. This company was still just growing earnings at a rapid pace. Sales were growing very rapidly. But again, when things get really extended in one direction, all it takes is one piece of news or one event to cause buyers to stop buying and sellers to start selling. And if sellers are trying to sell and the buyers are going, yeah, I'm not really interested in buying it, that price is going to fall until it finds buyers. This happens in every asset: gold, silver, platinum, stocks, bonds, you name it. But eventually there's going to be a point to where buyers go, okay, yeah, I think that's actually good value now because of it went from 120, went down to 60, 50% loss. Yeah, I'm going to start accumulating the stock. So we started seeing 3 standard deviations oversold, started seeing volume accumulation pick up, a lot of things like that. Stocks started to stabilize, but nobody wanted it at this point. If I tried to get you to buy a risk network, man, it just lost 50% of its value. I'm not buying that stock. Well, now the stock's trading back at all-time highs again, and you missed all this gain. So again, this is why, technicals mean so much, is that when these things get extremely extended, extremely overbought, you're going to have these corrections. But then at the same time, you've got to look at the inverse of that and say, okay, well, now it's no longer overbought. It's actually potentially well oversold. Valuations have come back, a lot better in line with where they are
You mean, so,
historically.
I'm just going to correct you. You're reversing them.
Yeah,
So
I
it
did.
was
Sorry,
oversold. Now it's
I did
overbought. Yeah.
reverse that. But
Yeah.
yeah, but valuations have now corrected. I'm very oversold, and now is a better time to buy things. And so, and this works with every stock, every investment over time. When things get really, really overbought and extended, learn to take some profits. You're going to get an opportunity at some point to buy it back cheaper. You just have to be patient and wait for it. And again, you can give me any stock, pick a stock that you want, whatever it is, and I'll show you the same chart.
Yeah. Let me ask you this. So again, just to bring it back to energy for a moment,
Sure. Yeah.
that's a sector, right? And oil is a sector. Well,
Yep.
I guess energy is an industry. Oil is a sector of the energy industry.
Yep.
So presumably the same thing works with sectors and industries as well, right? In other words, like you don't necessarily have to be out there trying to pinpoint exact companies. You could just say, hey, look, I think, again, oil as a sector really seems to be on sale right now. And so you could buy an ETF, right? Either of the producers or just of the commodity itself and just say, hey, I'm going to, yeah. Okay. The same approach
Yeah, no,
works.
no, literally it does the same thing. And this is why I wrote here, I just wrote this article week before last. Actually, I posted out last Friday, right before we did the show last Friday. But this is based, the article is talking about energy prices and economic indicator. This is the bullish oil bets down to 17-year lows. So in other words, people betting bullishly on oil right now is almost non-existent. That is a great contrarian indicator for something to happen to lead to a reversal in oil prices. And this happens all the time, right? We'll have some geopolitical conflict or something, and all of a sudden people go, oh my gosh, we're going to shut the Strait of Hormuz, and then the oil will shoot up $30, right, on this. But the reason that is, it's not because we're really that worried about the Strait of Hormuz. I mean, yeah, that's important. But what happens is that on the NYMEX, all of a sudden, everybody that's short oil, betting it's going to go down, has to cover those shorts, which
Right.
drives the price up. So now they're being forced to buy, and the more that the price of oil buys, the more it causes them to have to cover those shorts. So again, when you get to these very divergent periods, and you just look at the bullish oil bets, tells you all you need to know is that every time you're at these levels, what happens? They didn't keep going down; they went up, and this is because something will cause this ultimate reversal in the markets. And basically, we just kind of went through this oil price and events and what occurs. And again, there's always a reason why things happen. Either it's a backwardation issue or it's a taper tantrum or something. There's some type of event that's going on that's moving the price of oil as it relates back to what's happening in the economy. Again, there's a very high correlation. This is
Hey,
the
let's
blue
increase the
shape.
size of those charts if you can.
Yeah. There.
Thanks.
So the blue shaded background is a composite index of inflation, interest rates, and GDP. So that's a composite economic index. And it's got a very high correlation to crude oil prices. So crude oil prices declining, not surprising. You're also seeing that reflected since we use crude in every facet of our life, whether it's building solar panels or windmills to the clothes you wear, that all involves energy. So if that's slowing down, the price is declining, that's a supply demand indicator, then that also relates back to economic activity in all forms. So again, not surprising, this has got a very high correlation. But these deviations from the 4-year average, we've got a very big deviation from the current price of oil, from its long-term growth, its 4-year average growth trend. And normally when you get these kind of deviations below that 4-year average trend, you get a reversal in oil prices, and it's due to some event, whatever it is. There'll be something that happens that causes that very sharp reversal in oil prices. So personally, I'm getting very interested. We have a couple of energy stocks in our portfolio, but they're very small positions. I'm personally getting a lot more optimistic on a energy trade coming up sooner than later.
So what would you want to see to tip you into, okay, let's start buying?
Well, that's where we go back to. It's interesting too. A little bit different is that normally XLE as an ETF trades fairly closely to what's going on with oil prices. And there's a bit of a divergence now between XLE and oil prices where they're currently trading. But again, when you take a look at actual crude oil as a function itself, yeah. So this is oil. You're getting very, very deviated from its long-term average. And you'll notice, though, that's interesting is that even though that the price of oil is declining, you're seeing money flow starting to pick up. And normally when you see that, you'll start to see a reversal in oil. So you could see a reversal in oil really kind of as soon as next week. But I'd like to see a little bit more of a base form in here and then start to see this turn up. And that make me a lot more optimistic that we've got a tradable rally in oil coming.
All right, so you're not trying to catch the falling knife. You're waiting to see it bounce off a bottom.
Yeah, exactly. Sorry, I
Okay.
choked myself up.
No worries. I know talking about oil makes you Houstonians emotional.
Exactly.
All right. Well, let's see here. I'm just looking at the time. We're starting to run out. We might have to boot the rant this week. Um, but we've extra ranted in recent weeks, so I think folks will forgive us. So we gave super brief mention to this earlier, but let me just ask you to talk about it directly, Lance.
Sure.
So folks are looking at today's jobs report and saying, "Oh, yeah, okay, yeah, the Fed's definitely going to cut in September, cut this month." And looks like rate cut odds for 2025 are now minimum 3 cuts going forward from here. I think the market is currently pricing in, what is it, a September, November, and December. Those are the last 3 meetings.
Yeah.
So cut a 25 basis point cut at all of them, although there's still, well, there's probably heightened debate now after today's jobs data as to whether we'll get a 50 basis point cut this month or not. I guess, do you see those odds as probably the correct ones for now, or do you see it differently?
Well, I never know what the Fed's going to do. The Fed kind of does their own thing. And, like I said, they should have been cutting rates a while back. I just pulled up the Fed Watch meeting. So the target probabilities for a September 17th rate cut is now 11.8% for a 50 basis point cut and 88.2 for a quarter basis point cut. So they're still betting on a quarter basis point cut even after today's report, but it's pretty much a fix at this point that they're going to cut, 25 basis points.
Yeah. Okay. I will say, I just interviewed Lacey Hunt about a week ago, and Lacey very concerned about the slowing economy, and in his mind, he thinks the Fed is way behind the curve here, and he's like, I mean, they should be cutting like 100 basis points at this point in time.
I don't
Now, obviously, that
disagree with
would
that.
totally freak out. It's not going to happen. It would totally freak out the market if
Yeah.
it happens, right? But
Yeah, I absolutely agree with him. The Fed should have been cutting several meetings ago. He's absolutely right. And now they're so far behind the curve. I think it's going to come up and bite them in the butt at some point. But again, if they came out and look, I think they come out September the 17th and they cut by 50 basis point. You take a look at the 10-year Treasury rate as compared to the Fed funds rate. If the Fed cuts aggressively, that is because you're generally entering into an economic recession. Rates start to fall sharply, markets go lower, stocks don't perform well because you're having to start to reprice earnings for much slower economic growth. So, I think at this point, the Fed's is more sensitive to kind of the outlook that they put on the markets. And I think they realize that they come out and cut 50 basis points in September, which it's possible. I'm not saying it's not possible, but I think they realize if they come out in September and cut by 50 basis points, that they're going to freak out the markets because markets are kind of betting on 25. So maybe they do 25 and then say, hey, we're going to have to cut, we're going to be cutting at every meeting through the end of the year now. And, maybe they start to do that and then potentially even start talking about stopping QT.
Okay.
But I do think I think Lacey's right. I think they're behind the curve. And at some point they may have to start cutting more aggressively. But if they do that, that's not going to be good for the market.
Okay. So you and your colleague, Mike Leibowitz, have been more confident than most that the slowing economy was going to win out in terms of, where inflation heads versus tariffs, right? We've talked a lot that, you don't even think tariffs are really that inflationary in the long run.
Yeah.
Um, so we're seeing bond yields. They've actually come down a fair amount in the past couple of
Yep.
days, and when I checked a few hours ago, they were down pretty hard again today.
Yep.
Um, so at your portfolio meetings, are you guys having any discussions about increasing your exposure to bonds or bond duration at this point?
Well, right now our bond portfolio is structured for a Fed rate cut. So we have a lot of bonds allocated on the really short end of the curve, which are the most sensitive to rate cuts. Once we begin to see those rate cuts take effect and the economy begins to slow, we'll begin slipping out that duration to the longer end, which will pick up on slowing economic growth, falling inflation, and the drivers of long-term yield. So the first thing we're going to kind of work on capturing is the short duration part of the curve that's sensitive to Fed rate cuts, and then we'll shift to capture the economic slowdown, which is a much slower train to move.
Okay. And does that basically mean that you think rate cuts will happen faster than bond yields coming down? Meaning, you know, because the Fed can change the policy rate overnight and looks like it will in a couple of weeks, be in the short end of the curve for that, but it'll take a while for the slowing economy to start dragging down those mid to longer term bond yields.
Yeah, it's a slow the economic slowdown is a longer cycle
Yeah.
than rate cuts. So rate cuts are going to affect the short end of the curve. That's all they affect.
Yeah, I just want folks to understand
Yeah,
how this propagates along the curve. The
yeah,
short end moves real fast with the Fed policy change.
exactly.
The rest
And
takes
then
time.
and
Yeah.
then as it moves out towards the end of the curve, it's much less sensitive to Fed policy and more sensitive to economics. So as the economic environment continues to slow and deteriorate, then that long end of the curve begins to pick up, and we're getting very close to that point. It probably this time next year, we're gonna have a really good indication of where inflation and economic growth is headed, and also too, I mean, this past week, there's this whole issue about tariffs now. You had this one federal judge came out and said tariffs are unconstitutional. It's now going to go to the Supreme Court. I think there is the argument that the federal judge made in regards to tariff is not incorrect. Congress controls the power of the purse.
Mhm.
So that includes spending money and taxes and all that. So technically, the federal judge is right, is that the congressional body should have passed a bill to introduce tariffs in this environment rather than using an executive. This is the problem with executive powers, right?
Yep.
They're very easy to overturn.
Executive orders. Yeah.
Yeah, executive orders. Sorry, executive orders are very easy to overturn. You follow the congressional path and pass a bill. That's a much different story. So this is going to the Supreme Court, and I think there's a reasonable risk that the Supreme Court sides with the federal judge and says, yeah, if you want to do tariffs, it's fine, but tariffs are a tax, and that needs to go through Congress. And so we'll
It's
see.
interesting. Yeah,
And maybe I'm wrong. I mean, maybe wrong. Maybe
well, no,
the
no, no.
Supreme
I mean,
Court says no. You're completely fine. Go for it. But we may not have tariffs to deal with as a tariff impact. Is my point.
well, it's interesting. So I think there is probability there. I don't know, whether it's majority or not, but enough
Yeah.
that I think I've even seen the administration in the past 24 hours do a little like damage control of like, yeah, we may have to come up with a different solution for tariffs, right? But what's interesting is I've also seen reports in the past 24 hours of all of a sudden, I guess, on the Hill, tariffs have gone from, oh my God, they're a tax, they're going to be super inflationary and drive the economy off
Yeah.
the rails, to, hey, we've got hundreds of billions of dollars coming in every year now, and they don't seem to be as inflationary as they were. And like,
Yeah.
hey, if we lose this tariff revenue, oh my God, we're not going to be able to, we're not going to be able to fill that hole in the budget, right?
Yeah. No, it's funny how quick that tone changed in
Yeah.
Congress.
Well,
I
it's
mean, if
funny
I was
how
president,
quickly
if I
Congress people get addicted to money,
yeah,
right?
exactly. Well, but if I was, and this is that I was talking about this on the radio the other day, on our YouTube show the other day, is that, if I was President Trump, I'd say, okay, federal judge, okay, fine. I would go to Congress today and say, we're going to pass a single purpose bill. We're going to put a 10% tariff on everybody. We're just going to pass a bill, puts 10% on everybody. And you got the majority of the House, you have the majority of the Senate, pass it. And then it completely kills this whole deal over tariff constitutionality in one fell swoop.
Right.
And he should be able to do that fairly quickly because he has control of the House and Senate. Now, midterms coming up next year, who knows? But he could do it right now if he really put his mind to it. So, he could solve his problem on tariffs pretty quick.
All right. So there are a couple of interesting things that we don't have time to get into now, but I'll just flag them so that if we decide we do want to talk about them later, they're on the radar. One is this, what does the world look like? I mean, look, Liberation Day threw the markets into a massive tizzy, right? Which everybody
Mhm.
remembers. What happens if tariffs get pulled off the table, right? I mean, we're going to have a similar period of uncertainty, right? The other thing that just happened is, forgetting exactly what it's called. I think it's the SCO, the Shanghai Coalition, whatever. But we basically just had a meeting of the big countries that aren't on Team America, right? China, Russia, and India. I mean, India really seems to be saying, "Hey, America, I'm not gonna kowtow to your demands that I get on Team America here. I'm gonna at least try to straddle the fences here." But a lot of people are saying, "Hey, this is showing that the world is becoming perhaps a lot more bipolar than the U.S. has bargained for." I don't want to open that right now because there's lots to potentially say about it,
Yeah.
but it could be quite meaningful if indeed there's a bigger resistance to what the current administration is trying to do with basically trying to get the rest of the world on its side so that it can more or less isolate China to get China to agree to its trade demands.
Yeah, that's true. And again, but see, these are those issues that potentially have side effects that impact the financial market. So, all these topics are great, and we have no idea how they actually impact, what the outcomes of this going to be. But again, when, kind of regardless of kind of what the views are, we've got to pay attention to these issues because at some point, if something occurs that all of a sudden changes how Wall Street is expecting forward earnings to grow, then that's where these valuation issues become a problem. And they become a problem quick, and which is why we need to be paying attention to all these different factors. Even though they may seem irrelevant, one of these things could crop up and actually be the catalyst that sparks that sell off in the market.
Okay. Well, like I said, I'm just putting it on the board so that if
Yeah.
it actually starts becoming something, we know it's
Yeah.
out
Yeah. No,
there. By the
no,
way, it's the
it's
Shanghai
fair.
Cooperation Organization. That's what the SEO stands
Yeah.
for. Okay. Yeah, I'm gonna jettison the rant this week. So right before we get to your trades, last question for you, Lance. I've had a lot of either housing experts or analysts who look at housing really closely on the channel recently,
Mhm.
and it doesn't look good. And this is happening at a bad time, right? I just interviewed Danielle Park from Canada, and it's really instructive to see her analysis of the Canadian housing market because while there are some differences, it really does kind of give America a preview of coming attractions. And she is, basically saying, look, we got a stock bubble and we got a housing bubble here, and the housing bubble is already starting to correct. And in her mind, the stock bubble looks vulnerable. You don't have to necessarily agree with her,
Yeah.
but you know, lots to potentially be worried about. And again, a lot of bad data in housing. Um, why is Warren Buffett buying the home builders now? Or
That's a
why
good
is
question.
Berkshire Hathaway buying?
Yeah.
Yeah.
No, it's a good question. You take a look at, you know, it's a, I think for instance, like you take a look at Toll Brothers as a good example. I think you have to start looking at supply and demand imbalances, and these home builders are going to be forced to build a lot more homes in the future, right? So existing homeowners, and this is the theory, I think, in a lot of cases, is that existing homeowners aren't going to sell because they can't sell their house to go buy a 7% mortgage. So the only way to provide supply is for new home builders to build new homes. And so now new home builders are starting to build smaller square foot homes, those type of things, trying to fill that supply gap that's in there. Scott Bessent just came out last week and said that they're kind of kicking around the idea of maybe declaring a national housing emergency. Terrible idea, because that will definitely give us another housing bubble if they do that. But what would that mean? I have no idea. But would they provide a lot of incentives for home builders to build more inventory, et cetera? What does that mean? So you take a look at home builders, though, they trade fundamentally very cheap. So if you're Warren Buffett, I'm looking for fundamentally cheap stocks that are growing revenue and earnings. Toll Brothers is a great example. Trades at a 10 times forward PE, price to sales of 1.3. It's growing earnings on a really steady growth path. So and it has, runs a gross margin of 25%, operating margin of 18%. I mean, fundamentally, these stocks are doing great. Now, the one thing I don't like about Toll Brothers is that a lot of that, kind of earnings per share growth is all driven by massive stock buybacks. So I much prefer a company that's growing earnings and not buying back stock, because that's really telling you that the company's really firing on all cylinders. But these stocks but fundamentally, stocks like Toll Brothers, Beazer Homes, et cetera, they do trade fundamentally cheaply. And, look, I've got a lot of buddies in the real estate business. They are just chomping at the bit to get money invested back into real estate as soon as the Fed starts cutting rates, because that will start to improve cap rates.
Okay, so you think it might be a bet on lower interest rates, lower mortgage rates, and perhaps additional forms of government
Yeah.
intervention. Just FYI, just because you mentioned Toll as your example, that's not what Berkshire bought into. I think they bought into Lennar and D.R. Horton, and it's
Yeah.
not a big amount either. It's not like he's making a massive, strategic bet for Berkshire on this. But okay, those are interesting. And when Bessent made that comment,
Yeah.
I put out on X linking to it, and I was like, it's just really hard for me to hear this as anything other than problem created by too much central planning intervention to be addressed by more central planning
There's a plan.
intervention.
No, I think government should not get involved in housing. If you want to make housing more unaffordable, just like healthcare, right?
Or
Healthcare was
education.
when once government got involved in healthcare to make it cheaper, it became more unaffordable. Same thing for housing. If you want to make housing even more unaffordable, get the government involved in it.
Yeah, no, I sadly fully agree with that. All right, so Lance, trades. Sounds like you guys maybe haven't made that many trades over the
We
past week.
we have it. The portfolio is doing really, really well. We just, rerun a 60/40 allocation right now that is holding 12%, 13% cash. And we're basically 1 point behind the S&P this year. So, on a year-to-date basis. So the portfolio is performing very well. Our dividend equity growth model is actually performing right along with the S&P 500. So it's tracking it to the T this year. So again, there's not been a lot of need to adjust stuff. It's been very boring in the markets, and it's like, okay, should we maybe do something here or there? But we took profits previously. We added back to stuff that was really oversold, and there's a few things that are going on that some opportunities kind of popping up that we're looking at. But there's just hadn't been sometimes we've talked about this before on the show, is that sometimes you feel like you need to do something, and when you feel like you need to do something, generally it's best not to do anything. And that's really been the case. It's like, oh, we should really do something, but there's really not much to do. So there's no sense in trying to force it right now until there's kind of a clear pathway to making changes in the portfolio.
Yeah, I mean, I equate this to the science of hitting, Ted Williams,
Mhm.
which is he really understood exactly where in his strike zone he could really knock the ball out of the park. And his job was really just to wait for the pitches that really got into
Yeah.
that sweet spot, right?
Yeah. And that goes back to our conversation earlier about trading portfolios and managing money. Is that article about portfolio risk management? It starts out with the Hall of Fame, the 10 Hall of Fame best hitters and throughout history. And you look at their batting averages, they're all like 365 on average, which means that every time they went to the plate, they struck out a whole lot more than they actually got a hit. And so we started off with that because it was a quote by Steve Cohen, who runs Point 21 Capital Management, which is one of the best hedge funds in the world. And he said his best trader is right about 55% of the time, and his average trader is right about 45 to 50% of the time, which means they're losing trades more often than they make money, but they just limit the losses on their trades.
Right.
So, and that goes back to the whole risk management analogy about, why it's so important to limit your losses and manage your winners at the same time, learn to take profits, rebalance risk, those type of things. But if you can just limit those losses, you're going to have a lot more losers than you have winners, but the winners can really make the difference over the long term.
So absolutely, and you just add to that the patience of a Ted Williams. I think we talked about this before.
Yeah.
Warren Buffett says, "Hey, look, and the difference between investing and batting is he's got to swing, right? If the ball's in the strike zone, he's got to swing, or else,
It's a strike.
he strikes out, right? So he's got pressure to swing the bat. Where he's like, as an investor, I can take a million pitches and
Yeah,
weight them all if they're not great, right? So basically, why make an investment that you don't feel great about, right?
that's right.
So the patience that you're exerting by just saying, hey, there's just nothing right now that's really making us super excited.
Yeah. And just because the stock's going up doesn't make it a good investment.
Yes, exactly. All right. Look, I just want to end real quickly. This is not a rant. I just want to get your top level reaction to it, Lance. I what I try to do with thoughtful money is to try to help, regular people better understand what's going on in the markets and in the macroeconomic world. And I try to distill it down to digestible, things as often as I can. And you and I have talked about this, that to build wealth in the long term, there are three muscles you need to develop. There's your earning muscle, there's your savings muscle, and there's your investing muscle.
Hmm.
Right. And in general, I think you if you're just starting out in life, you want to develop them in that order as well. You can't savings not going to help you too much if you've got nothing coming in, right? And you can't invest if you haven't saved, right? So there's sort of a progression there. So I just put out this poll on X just to say, hey, if you're evaluating your own development of those muscles, which one do you think you're best at? And what's interesting here is people said they were pretty good at the best at saving, investing kind of a close second. The earning muscle was the one that people rated themselves lowest at, except for those who just said, "Hey, I'm bad at all three, and I need
Yeah.
to hit the gym," right? And this is interesting, but given our talk, Lance, about what's going on in the employment market and where the economy looks like it's headed, I think this is a time more so than others where really working on your earning muscle is really key, because the thing that kills people during recessions is earnings compromised, right? Getting your earnings compromised, either by losing your job or getting your hours cut or whatever. So, I'd love to just get your thoughts in general on this, but also like, this may be a time where trying to develop some multiple streams of income just in case you lose your primary one during a potential recession here, it's not going to be quite as devastating as otherwise.
No, that's right. I mean, we talk a lot in, our shop with individuals about, building up a cushion and, a savings bucket that in case you lose your job, you've got 6 months worth of salary set aside so that you can survive until you can find your next job. But again, it's hard to do, right? When you're just trying to make ends meet, those type of things, trying to save that extra cash is very difficult. But, again, this is what I talk to my daughter about, all the time is like, look, you've got to do three things. One, you've got to separate out needs from wants. And you think a lot of your wants are actually needs, like I need a new phone. You really don't.
Right.
right? It's just a want, but you can't classify that as a need. So you got to start sorting those things out so that you can start saving money. And, and if you can learn to live on what you're bringing home from your primary job, then work a part-time job to create your savings bucket so that you can create money and save that and then eventually get that invested. But again, we can't invest until we have a savings bucket set up as well. We need that cushion. We need that emergency cushion put into place first before we even start investing. You know, let's say you need $10,000 to cover 6 months worth of your savings or 6 months of living, whatever it is. So save up that 10,000. Then you need to save up another 10,000 to go invest with. And that way, if something happens with your job, you're not forced to liquidate your investments to pay bills with. You've got that cushion to help support you for 6 months until you can find a new job. But then that way you can leave your investments alone to let them grow. But the problem is we tend to put those in reverse order. We start throwing money in the market because it's going up and I can get rich quick this way. And we start treating it like a casino. And then when something blows up and I lose my job or whatever, now I've got to go liquidate all those assets. And probably the reason I lost my job is because the economy is turning down, which means the stock market's going down at the same time, which just is a huge whole compounding effect on the value of your wealth. And this is why so many investors wind up, not having wealth by the time they reach retirement because of just, these events that occur in life and they happen all the time, but being unable to navigate them safely.
Yeah. And to your point about wants and needs, and this may be an unpopular comment, but
It's always unpopular.
yeah, I know. I mean,
It's
it
like talking
certainly
about
works.
budgets.
Certainly works on a budget side of things, like the cost side, right?
Yeah.
Like, hey, you know what? You say you have to have that, but you really don't, right? Your whole thing about getting super creative, and as a guy who lived out of his car, you often remind us that, hey, you can get by with a lot less than you think. And I think the same thing on the earning side, to be honest. I've known a lot of people in life, and this is coming, folks, from a self-described workaholic. So I understand I'm wired this way, and I probably should have a little more life balance, work-life balance in my life.
You and me both.
Um, yeah, but I know a lot of people who are just like, all right, it's 5 o'clock, done, and I'll see you guys at 9 tomorrow, right? Or hey, my weekends are sacrosanct, right? And I'm all for preserving time in your life to appreciate your family, to be able to indulge in the things that bring you joy and peace of mind. But there's sort of a time for everything. And, the way you and I are wired, Lance, like, if you're not at a point of strength, of real stability, that's when you want to be just working in overdrive to try to get to that point, as best as you can. And I guess where I'm going with this is there probably is a lot more bandwidth in your life than you currently think to either lean into your current income and dial it up either through overtime or taking on additional projects at work that you can get compensated for, or setting up a side gig or a side business or whatever. And so just as you want to be, look at the hard truths of, hey, where can I cut costs? Look at the hard truths of, hey, where do I have additional bandwidth and opportunity here to work on driving more income in here? So
Yeah.
I'll,
No, it's fair. I think one of the worst things that we pushed onto the younger generation was this whole, and this really kind of happened, just going into the 2020 pandemic, but also really coming out of it, is that we started this whole narrative about work-life balance. It's like, well, we need more work-life balance. We need to develop the European model of working in the States and have this work-life balance. That's a terrible narrative. Because again, you find somebody that's wealthy, doing well, they're doing successful, they don't have work-life balance. They're working. And they may have work-life balance later on. And it's like Dave Ramsey always says, so you can live like nobody else today, so you can live like nobody else tomorrow.
Mhm.
And that's a fair statement. And so you just have to decide what's important to you. If you want work-life balance, there's fine. There's nothing wrong with that, right? You go put in your 8 hours at work and you can go home and have your work-life balance and play video games, whatever it is that makes you happy. That's awesome. Nothing wrong with it, unless you want to aspire to more. And if you want to aspire to more, you're going to have to put in the time to do it. You find any small business owner, they work 80 hours a week. They work 100 hours a week. They're working weekends. They're working holidays. They're working, nights. They're working whenever it's required to run that business to make it successful. And those are the successful entrepreneurs, and they do well. The guys that don't do that, they typically go out of business in fairly short order. That's why 80% of businesses fail over a fairly short time frame, 2 to 3 years, they fail. So again, it's all depends. And again, I'm not telling you, Adam's not telling you, we're not telling you you have to do this, right? And yes, there may be somebody out there that did work-life balance and they worked it out and they became very successful. And I'm sure that's happened, right? But it's a rarity. For most people, when you look at the really successful people in the world, they go, oh, he's an overnight success. It only took him 10 years to get there, grinding it out, but he eventually made it. And that's what we see as the success side of it. So you just have to decide what's important to you. If you want success, if you want wealth, if you want to build these things, it's going to require sacrifice, it's going to require discipline, it's going to require hard work. If you can just learn to live with those three things, you can be very successful and very wealthy. If you can't live by those three things, then you need to think about a different pathway maybe in life. And because again, it's very hard to achieve greatness without sacrifice, discipline, and effort. And just it's any event, whether it's investing, saving, growing wealth, or participating in a sport.
Right. Or
Find me
relationships.
find me a professional athlete that has work-life balance.
So it looks like we got a rant out of this anyways. It didn't
There you go.
intend to, and I'll wrap it up for a bit. I agree with everything you said, Lance, and to me, this is somewhat similar to our conversation we were having 30, 40 minutes ago of everybody's fine with their investing strategy, and they're fine with not harvesting and position sizing that you're talking about until the losses come,
Yeah.
right? And then it's like, this sucks. I really wish I'd done something differently. And for me, a big factor here is about control of how you live your life. Are you living your life on your terms, or are you living your life on reality's terms? And to a certain extent, we all live life on reality's terms, but the more successful you are, the more you have the ability to kind of bend reality to your will,
Mhm.
right? Where if you don't, and it's okay if you choose not to, but you're just going to be more affected by what happens in the economy, in the markets, et cetera. If you're not putting this stuff in, and you'll be more vulnerable to having your hours cut or losing your job or whatever. You're going to be more vulnerable to continued increases in the cost of living. And if you're doing okay right now, you might feel like, well, I'm fine, and that's cool. But you just have to make sure that, okay, well, look, if there's an economic down cycle here, and I'm in a position where I can't really bend reality to my will, I got to realize that's the other side of that coin.
Yeah, that's right.
Yeah. All right. Well, look, folks, you're reminding me in this conversation, Lance, who knows what's going to happen with the economy. Let's all hope that it doesn't fall apart from here. But if you work for a living, meaning you get a paycheck for a living, meaning your employment depends upon your employer continuing to employ you. If you haven't read Thoughtful Money's layoff guide, layoff survival guide, I highly recommend you download it today. It's totally free. It's just at thoughtfulmoney.com/layoff. And it's got basically two sections to it. One is all the things you can do today in advance of a layoff to reduce your vulnerability to getting laid off in the first place. And then the second part is all about, okay, if you walk in and you get surprised by a pink slip, what are all the things you should do right then and then in the weeks afterwards? And there are some things you want to do right away. So if you have any potential vulnerability into your income of getting summarily fired or laid off, go make sure you read that layoff guide, and it'll help you more if you read it in advance of getting laid off than not. All right. Well, look, if if you think the best first step in bending reality to your terms is to continue to watch Lance Roberts on this channel week in and week out, let him know that by hitting the like button, and then by clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like some help from a professional financial advisor in figuring out how to maybe put that framework together for buying and selling in your life, or you want to leverage their expertise to do that for you going forward, especially if things unfold from here the way that Lance thinks they might. If you don't already have a good financial advisor doing that for you, consider scheduling a free consultation with one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to have that conversation with Lance and his team there at RAA. So to schedule one of those consultations, just fill out the very short form at thoughtfulmoney.com, and the firms will be in touch with you right after you do that. Lastly, just a reminder that the Thoughtful Money Fall Conference is coming up. It's going to be Saturday, October 18th. Don't worry if you can't watch it live. Everybody who registers will be sent replay videos of the entire event, all the presentations, all the live Q&A. We are getting, I think I've mentioned most of the faculty that have signed up for it. In this past week, we've had 2 additional big additions. We just had Sven Henrik agree to come on and do a bespoke presentation of his charts for the conference. And then Lynn Alden just signed on, and we're going to have her talk specifically about Bitcoin this time around. So it's continuing to build up to be probably the best event we've yet done. And of course, it's proving to be extremely timely given all the uncertainty that's building right now, both macroeconomically and in the markets. So if you have not yet bought your ticket, run, don't walk to get it now at thoughtfulmoney.com/conference. We are still making tickets available at the lowest early bird price discount. So I want to make sure as many people lock in their ticket at that lowest price as possible. And if you are a premium subscriber to our Substack, make sure you look for the code that I've sent you that will let you get an additional $50 off of that early bird price discount. All right, Lance, that's it. End of the week here. Another great discussion with you. Hope everything goes well with you and your family. I know you're off to do a little bit of rest and relaxation this weekend. So I hope you and your wife get everything you need from that. As usual, I'll let you have the last word.
No, that's it. Yeah, just I don't know what's going to happen next week, but yeah, just buckle up. It's going to get fun here over the next couple of weeks as we have the end of the quarter.
Okay, and yeah, we should say, folks, right now it's looking uncertain that you'll be here next week, just given some things that are going on. So don't be surprised if instead of Lance, we have Mike Leibowitz. Yeah, we'll probably have a little party for that anyways, Lance.
Exactly. Well, my plan's to be here, but yeah, we'll see what happens.
All right. Well, we hope you are. Okay.
Yeah.
Lance, buddy, have a great time. Everybody else, thanks so much for watching.